People who are technical traders. There are people who are momentum traders. There are people who are sentiment traders. That's not what I am. I'm an investor. And by education, I'm a value investor. So I use the strategy that's worked for me that I'm comfortable employing. Because I'm comfortable employing my strategies, I'm unimpacted by volatility. People that have never developed a strategy or don't follow their strategy tend to be shaken out of their investments during times when they mistake volatility for risk. So I never change what I do. There was a time in the early part of the decade of the 90s when optionality was free. Nobody expected the gold or silver price to rise. And so you could buy gold assets in the ground for $5 an ounce, $10 an ounce, understanding that if gold repriced, that those assets would underprice. That worked because nobody was buying gold optionality. People buy gold optionality now. So in order to participate in that game, you're exposed to things like $2 billion market caps, which I don't do. I'm an absolute value guy, not a relative value guy. There are lots of other ways that work for people who are good at them, but that's what works for me. It's what I understand, so it's what I do. There's a whole bunch of silver dross out there. Little companies whose real exposure to silver is confined to the fact that they have silver on the name of the company and the share certificate. The price of something goes up and you don't have any. It shouldn't matter very much, but I guess sentiment matters. The phenomenon that you describe is extremely important for people to understand. I experienced it personally in the early part of the decade of the 90s, where I was part of the genesis of both Silver Standard and Pan American Silver. Those two companies escalated from our first financings, 50 cents on Pan American and 72 on Silver Standard, to 5 or 6 years later, plus $40 bids. People don't understand the upside in legitimate silver juniors. They're the most volatile asset class in resources that I know of. The caveat is that you have to be involved not merely with narrative, but with high-quality people, with Ross Beatty's and Bob Quartermain's, and high-quality deposits. There are a few of those out there. I would suggest that Abra is high quality. I would suggest that Vizsla is high quality. I would suggest that Aya is high quality. And there are a couple others knocking on the door. As you suggest, a couple of the small producers, Gatos and Silvercrest, got gobbled up. That's okay. Got paid a nice premium. If you wanted, you could take shares in the acquirer so that in the run-up in silver prices, that deposit will continue to benefit you. But there's a lot to be said for doing the work to establish a 5-stock position among the silver juniors, and then just relaxing until the generalist investor comes into space. I've never seen a frenzy around anything, with the exception of uranium in 2002, that resembled the silver frenzy, the junior silver frenzy that I experienced in 1992, 1993, 1994, and 1995. It was unlike anything. I was identified as the sort of promoter between Pan American and Silver Standard. And institutional investors would call me up saying, "How are you doing this?" And I would say to them, "Well, that's a trade secret. It's not available." The truth is, I wasn't doing anything. The market went absolutely crazy. What happens in a bull market, for people who were early in the bull market, they bought a narrative before the narrative came true. As the narrative begins to be demonstrated by the price appreciation of the product in hand, that very price appreciation justifies the narrative. But that price appreciation devalues the narrative. In other words, if you think the gold price is going to triple, and then the gold price triples, your narrative is done. Perversely, you believe in it even more because you feel good, particularly if you were tested early in the period. I, as I've told you, Jordan, came into the market in the 1970s, the wildest bull market that resources have ever seen. I had the good fortune to come into it very early. And because I was naive, I played it very aggressively. And as a consequence of playing it aggressively, I outperformed many people who were substantially smarter than I. And I came to believe, perversely, as a young testosterone-driven male, that my performance had to do with my genius, ignoring the fact that the gold price went from $35 to $850, and the oil price went from $2 to $30. And I ignored, too, the fact that markets work, that the cure for high prices, including commodities, is high prices, including commodities, and that the market would correct. And come about 1982, when that commodity bubble burst, I learned just how smart I was, which is to say, not very. The good news is that I have been able to guard against my own hubris ever since. I have been able to say, "Rick, is this getting too easy? You are starting to make money on your mistakes. Do you remember how bad you felt when you went from being a wealthy young man to having a negative net worth? The answer to that question, by the way, is yes. And I have managed ever since 1982 downdraft. I have remembered to take advantage of the bull markets. I remember once in Midland, Texas, after the crash in oil that occurred in the mid 80s, seeing a wonderful bumper sticker on a car. Said, God, one more bull market. I promise not to waste this one. And I remind myself of that, just like I reminded myself a couple of weeks ago that the reason that I had bought added positions in the uranium juniors was because they were going to overcome hate. And for that part of my position, not my whole uranium position, but the part that was bought in anticipation of overcoming the hate, when that goal was met, I had to sell a stock.
Look, I want to start by saying something that might sound counterintuitive for someone who's made his entire career in the resource markets. I really don't care much about daily price swings. And if you're serious about building wealth in commodities, neither should you. People get obsessed with the tick-by-tick action in gold or silver. They call me up, sometimes literally asking, Rick, silver dropped 50 cents today. Should I sell? Should I buy more? Should I panic? And my answer is almost always the same. Stop looking at the price for a second. Look at the value. The simple truth is, volatility is not risk. It's the mechanism by which you are compensated. Without volatility, there's no opportunity. Without opportunity, there's no outsized return. I want to be paid to endure that volatility. And over my life, I've been paid very well for doing just that. I've said it 1,000 times, but it bears repeating here. You make money in bear markets. You just don't know it at the time. You're buying assets that are hated, unloved, misunderstood, or ignored. You hold them. You get comfortable being uncomfortable, and you wait for the inevitable mean reversion, because the world always reverts to the mean. And then, when the crowd finally piles in, that's when you cash out. So what does that look like right now, practically speaking? Well, let's start with the backdrop. The United States, and most of the Western world, is in the worst fiscal position I've seen in my career. You have governments that are addicted to deficits. You have voters addicted to free stuff. And you have a political class that can't get elected by telling hard truths. So what do? They inflate. They debase. They promise that the solution to too much debt is more debt. It's madness. Now look at the balance sheets. Look at the Federal Reserve. Look at the European Central Bank. Look at Japan. You'll see bloated books filled with IOUs that can never be honored in real purchasing power. So they'll be dishonored the old-fashioned way, through the silent tax of inflation. And inflation, despite what the official CPI tells you, is nowhere near back under control. They want you to believe it's 3 or 4%. Try telling that to anyone who's paid for groceries or car insurance lately. Or try talking to someone who's buying a house with a mortgage at 7.5%. The lived experience of inflation is dramatically worse than the official numbers, and the market knows it. That's why gold has been stubbornly high. That's why it recently closed at the highest weekly level ever. And it's why silver is finally starting to stir after years of relative dormancy. So let me take this opportunity to revisit a theme I've hammered on for decades, because it's probably more relevant now than ever. And that's the concept of optionality. When you have a market like we do today, where risk is systemic, where governments are effectively guaranteeing long-term currency debasement, where central banks themselves are some of the biggest gold buyers on the planet. You want assets with embedded upside that isn't being priced in. You want that asymmetry. That's why I keep circling back to high-quality gold and silver juniors. I've seen this movie before. Back in the early 90s, nobody gave a damn about silver. We were able to pick up silver optionality for nickels on the dollar, literally buying ounces in the ground for $5 or $10 that would be worth exponentially more if silver moved even modestly. And when silver finally broke out, it was as if a dam burst. Pan-American silver, silver standard. Those were not just good trades. They were life-changing investments for a lot of people who had the guts and patience to sit through the dead years. Now, some people hear that and think, Rick, that was then. This is now. Surely the market is smarter. Surely everyone already sees the opportunity. And I would say, really, because the data doesn't show it. The silver juniors are still priced as if nobody believes silver will ever sustain above $40 again. You still have people in the generalist investment community who giggle when you mention precious metals. They think it's a pet rock. They're too busy buying the AI narrative at 30 times sales. Meanwhile, the physical market tells a very different story. Look at the monthly deliveries out of COMEX. Look at the shrinkage in available inventories. Look at what the biggest players in the world are doing. Sovereign wealth funds, central banks, even big family offices. They're positioning in hard assets quietly, while retail is still obsessed with the NASDAQ. This is one of the reasons I love silver right now. It's the most asymmetric bet on the planet. And here's the irony. It's been suppressed so methodically by Western banks that they've created their own trap. You've got 8 of the largest banks on the planet holding the biggest concentrated short position in any commodity in COMEX history. Why? Partly because silver is strategic. It's critical for high-tech weapons, electronics, solar, batteries, you name it. It's also monetary, and nothing scares central planners more than an asset that reveals the fragility of their paper schemes. You know, I gave a speech in Vancouver a few years ago where I pointed out that the US military uses hundreds of ounces of silver in a single modern cruise missile. I finished the talk, and a guy approached me afterwards. Turns out he was an engineer who'd worked on Tomahawks. A year later, he finds me again with declassified documents. Shows me the actual figures, 13 to 14 kilograms of silver in a single missile tip. That's 500 ounces. Multiply that by the thousands of missiles, drones, radars, satellites. You start to see why suppressing silver is a matter of national interest.
Well, at risk of being self-serving, which of course I am, the Rule Classroom is very good. There's 200 hours of instructional programming there, including 11 hours of real how-to called Introduction to Natural Resource Investing. There's a lot of free sources, there's a lot of paid sources, and a lot of them are good. It's important that you consume those sources consume sources that communicate to you. There are people out there who, I can't imagine this, Jordan, but they consider me to be an arrogant, smug human being. They probably shouldn't go to the Real Classroom. I am who I am. And if you can't consume the information from me, there are other places to get it. But the point is, do it. I think the important thing, Jordan, that people must do when they come into the sector is they have to do what you did. They have to assess themselves. They have to assess their strengths, their weaknesses, their goals, their timeframes, and then they have to begin the process of systematic education. The sector doesn't change that much. Past is prologue, but you have to do the work to understand what the past was so that you can use it as prologue. You did the work, and newbies to the sector need to ask themselves whether or not they're willing to do the work. Does it interest them? If it doesn't, if they understand the gold narrative and they want to use gold to protect themselves in the future, they should buy some gold, and they should buy the best of the gold stocks, the best, and they should get on with their life. If, by contrast, they begin to get absorbed by it, they have competitive instincts or intellectual instincts like your own that suggest that they want to outcompete the beta, that they want to generate alpha, that's very different. Then they need to begin the process of outcompeting other investors. And you do that by having better access to information and a better ability to assess information. Informal tool that I've used for 30 years has been the frequency or infrequency of transactions by prospect generator. When I see prospect generators in their quarterly reports to shareholders showing increases in transactions, which is to say them being able to farm out more projects than they were a year earlier, when I see this across the length and breadth of the 40-something prospect generators that exist, I know that the game is on. I know that the financing window is open. I know that management teams who haven't taken on projects because they prefer to get paid salaries are becoming more aggressive, and that means that money is becoming available. There are probably more efficient indexes than that, but I don't know them. I follow funds by actually follow funds, which is to say, when I see transactions that are being funded by the vendors, then I know money's back in. And by the way, money's back in the space.
So you think money is now starting to come into the exploration stocks?
I know it. The second thing I see is in a very small population of high quality exploration stocks, and this has been true for 2 years, their private placements are overfunded. I'm a fairly well-known investor, and many companies tell me that having me on their register or being able to announce me in a press release is a positive for them. And I find myself, despite this alleged advantage, being cut back in financings. That's not the mark of an underfunded sector. Now, the lame, the halt, and the blind, the dross, which is 85% of the listings, they're still having difficulty raising money because the investors haven't totally taken leave of their senses yet. Most of the sector shouldn't be financed. It should be allowed to return to its intrinsic value, which is zero.
And so, to wrap up that thought, the reason I keep hammering these lessons home is because they are timeless. The names change, the sectors change, the flavor of greed and fear changes, but human psychology never does. It's exactly why we see the same boom and bust cycles over and over. Whether it's uranium in 2006, cannabis in 2018, cryptocurrencies in 2021, or silver juniors in 1994, the pattern repeats. Someone once joked that history doesn't repeat, but it sure does rhyme. In the natural resource markets, it's more like it writes the same song on repeat with slightly different lyrics. So where does that bring us today? Well, look around. You have a macro environment that, in my entire career, I'd argue is more constructive for hard assets, for tangible, scarce, extractive resources than it has ever been. You have an entire generation of central banks that printed their way through the last dozen crises. They papered over every credit contraction, every tech bubble bust, every mortgage meltdown, every COVID lockdown, with more liquidity, more debt, more monetary debasement, and now they're trying to pretend they can normalize it. We went from 0 interest rates to 5% in a blink, trying desperately to clamp down on the very inflation they cause. And what's the result? $34 trillion in federal debt, more than $100 trillion in total debt across the US economy. Debt to GDP that looks like a banana republic. Now, common sense tells you there's no way to ever pay this back in real terms. You can inflate it away, you can default outright, or you can do some mix of the two, stealth default through persistent negative real rates. That's the policy choice they've made, whether they admit it publicly or not. And what does that mean if you're a prudent investor trying to protect purchasing power? It means you go back to first principles. You don't look to Wall Street's latest financial engineering. You look to timeless stores of value. You look to gold, you look to silver, you look to real assets, productive farmland, maybe even quality energy plays. I want to circle back on silver in particular, because if you followed me for more than 5 minutes, you know I have an enormous respect for silver. It's volatile. It'll make you question your sanity, but it's also one of the few assets on the planet with an upside so asymmetrical, it defies neat modeling. I used the word asymmetrical earlier, and let me illustrate exactly why. When you buy silver at $37 or $38 an ounce, maybe your downside, barring a complete macro miracle, is what, $10, $15 lower? Could be, although the cost curve would argue you're unlikely to stay there long. But your upside? What if you get a true monetary panic, a breakdown of confidence in fiat, a rerun of the 1970s when gold went up 25-fold and silver went up 38-fold? Or even a more modest replay of the 2009 to 2011 move when silver nearly tripled in 24 months? Your upside isn't 20% or 30%. It's hundreds of percent. That's asymmetry. Now there's another reason I pound the table on silver, and it has to do with what I'd call sentiment asymmetry. Nobody owns it. Institutions ignore it. Advisors hate to recommend it, partly because it's volatile, partly because it doesn't yield. If you look at total investment capital globally, $500 trillion give or take, silver represents a tiny speck, not even 0.1%. So if even a sliver of that capital decides it needs a real asset hedge, there simply isn't enough silver to go around. This is precisely why I often talk about a silver frenzy being inevitable. It doesn't start because Wall Street wakes up one day and decides silver is undervalued. It starts because silver's price action changes, and suddenly generalist investors, newsletter writers, hedge funds chasing momentum, they all come running in. They're not early. They're not buying because of the fundamentals. They're buying because the chart tells them to, and by the time that happens, if you're not already positioned, you'll be too late. I want to be brutally honest about that, because one of the most powerful emotional drivers is regret. I saw it in the 1970s. I saw it again in the uranium market in the early 2000s. The people who hesitated early because they let short-term volatility scare them out were the same people desperately trying to buy at triple or quadruple the price later. I remember getting phone calls from very smart institutional investors in 2006 who said, "Rick, I know I could have bought uranium participation at $3. It's $12 now. Should I get in?" And by then, a huge part of the asymmetry was gone. It doesn't mean it was too late. It just meant they were paying up because they missed the uncomfortable part of the move. And that's the key lesson. The uncomfortable part is when you make your money. It's when you sit there, owning assets that the world thinks are crazy or dead or boring. It's when you read about kids making millions on meme coins or TikTok side hustles and wonder if you're the fool for sticking with ounces of metal. That's exactly when you're planting the seeds for serious long-term wealth. I told you before, when I started out, I made money hand over fist in the 1970s. I also gave a bunch of it back in the early 80s. Why? Because I mistook a bull market in commodities for my own genius. The gold price went from $35 to $850. Oil went from $2 to $30. I thought I was the next Warren Buffett of rocks and drill rigs. Turns out I was just lucky to be young and aggressive in the biggest commodity boom of the century. Then came the bust. By 1982, the market reminded me, painfully, that trees don't grow to the sky, that commodities are cyclical, that the cure for high prices is high prices. And so I learned humility. I learned to watch my own enthusiasm with suspicion. I learned to ask myself, "Rick, is this getting too easy? Are you making money on your mistakes? If so, it's time to start harvesting. It's time to remember that bear markets follow bulls like night follows day." Now, if I zoom back to today's gold and silver landscape, here's what's different. The monetary backdrop is utterly toxic for fiat. You have interest rates that can't rise enough to slay inflation without blowing up the entire debt pyramid. You have central banks explicitly pivoting to gold. You have sovereign nations settling trade outside the dollar for the first time in 50 years. And you have a demographic wave of investors, think millennials, younger Gen X, who've never seen a real inflationary cycle in their adult lives. They're about to learn. I also want to circle back to the juniors because they're where fortunes will be made and lost. I've lived through enough cycles to know that the best returns are always in the juniors. I was there when Pan American Silver and Silver Standard went from pennies to over $40. I had institutional funds call me saying, "What's your secret, Rick?" And I'd laugh because the truth was there was no secret. The market was simply going bananas. If you owned quality names, you got rich. If you owned junk, you still did okay until the bust came. That's why when people come to me asking how to build their silver portfolio, I always say, do the work. Find 5 high-quality juniors, not just any 5 stocks that have silver in the name. Find companies with real deposits, proven management, conservative balance sheets. Then take your position and wait. Be willing to look like an idiot while everyone else is chasing AI stocks or Instagram side hustles. That's how wealth is built. And remember what I said earlier. Silver juniors are the most volatile asset class I know. They'll go up 3-fold, then cut in half, then double again. If you can't stomach that, stay away. Because your emotional discipline will be tested like never before. But if you can stomach it, if you understand that volatility is not risk, it's just the price of admission for asymmetric upside, then you're set. I saw this bumper sticker once in Midland, Texas, after the oil bust in the mid-80s. It said, "Lord, give me one more boom and I promise not to waste it." That's exactly how I feel about this cycle. And I remind myself daily not to let hubris creep in, because the market has an uncanny way of humbling even the smartest investors. So where does that leave us today? In my view, we're still early. You have gold at all-time weekly closing highs, silver starting to wake up, the monetary backdrop deteriorating, sovereign buyers crowding out supply, and yet the generalist investor is still nowhere to be found. They're still buying the dip on mega-cap tech, still stuffing money into ETFs, tracking indexes that are loaded with companies that rely on cheap debt. They have no clue what's coming. When that changes, when generalists finally realize that the fiat emperor has no clothes, When inflation is obviously entrenched, when debt markets start cracking in earnest, that's when the silver frenzy begins. That's when people stop asking if they should buy silver and start asking why there's none left to buy. That's when you want to be long gone from the buy side in deciding how much to let go into the frenzy. And I'll leave you with this. I don't invest in silver or gold because I expect them to go up. I invest in them because I'm terrified of what happens if they don't. If gold and silver fail to protect purchasing power over the next decade, it means the entire monetary system survived by some miracle of debt-fueled productivity that has never existed in history. Possible? Maybe. Likely? Absolutely not.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.